interesting nowadays, and everybody wants to understand the alternative route of investment, because investors always think something different should come. So we have learned the traditional investment avenue like mutual fund, stock market, ETF. Another thing is available, then PMS, and then our RIT and InvIT. These are the things. But the market wants to understand new thing because this is becoming saturated. And in the market, volatility is also taking place. And the investor is also always try that what other alternatives are there, because everybody wants, they don't want to put all eggs in one basket. So they require other avenues also. So that's why this alternative investment fund to diversify your portfolio and unlocking strategic wealth creation opportunity has emerged. Now this AIF is governed by SEBI regulation. Nobody can do this without SEBI registration. And AIF compass a range of asset class, including private equity, venture capital, hedge fund, and structured debt. And they offer the high growth and correlated investment theme. Now, today's webinar, we want to provide you comprehensive awareness, understanding of AIF as investment tool in India for high net worth individual, family offices, institutional investor, and accredited investor. Now, when I say high net worth individual, because this AIF is not for retail investor, because here the minimum investment size is 1 CR that you have to commit. The amount can be slowly can go, but you should commit 1 crore rupees. So retail investor is not coming, and they are not, so it is not suitable for them because here the risk is more. So those who are investing, they should have appetite of risk and simultaneously knowledge also. So today we want to discuss this, and we want to create that participant will gain insight into how AIF can be integrated into broader investment strategy. So today's program is not just for the sake of knowledge sharing, but those who are investing and they want to done something, it is for them also. So today we will discuss the main point in this. One is introduction of AIF, a overview evaluation. So you should know, because this is a new concept, so you should know this. Then type of AIF in India, what are the AIF and what types of AIF available in India, who can invest in AIF, benefit of investing in AIF, investment strategy and asset class, AIF versus other investment vehicle, emerging trend and future outlook of in AIF. All these topics we will cover, and we have invited galaxy of expert in this area. First, I will introduce Manoj Kumar, Partner Head, M&A and Investment Banking, Corporate Professional. Manoj is looking after the investment banking and the merchant banking side. So he can tell us that in what opportunity is there for investor, what opportunity is there for the corporate world. They can contact for the AIF, and how the AIF investor and the primary market or SME market can be correlated. Then we have a Sanchit Vijay, Partner Head, Deals and Valuation, Corporate Professional. Sanchit will explain about the AIF structure, how the growth is taking place, and various other gamut of AIF he will discuss. Then we have Ravi Prakash, Associate Partner, Security Law and Corporate Litigation. He will tell about the legal aspects and certain tips for investing and how this structure can be created. Then we have a Shivanshu Birla, Founding Partner of Makia Capital, which is a Cat 1 SEBI registered AIF. He has doing so many things. So he will share to the investor that what are the opportunity, how they can do, that will come. And then last we have a Bhavam Malhotra, is Associate Security Law and Corporate Litigation and Corporate Professional. And he also incorporate the AIF. So what are the main conditions? What SEBI does? So on the investor point of view, he can tell us. Friends, before I'm shifting to the basic point, I just want to inform you that on 30th May 2025, we are having our next webinar on Friday, that is ESOPs under the spot, regulatory changes in ESOP disclosure for listed entities. Now, friends, I just want to give you the brief introduction about this AIF. Now, as you are aware that we have seen that so many people are there, India having a one of the highest saving community in the world. We are having a 27 to 30% we are saving. And then this money people want to invest. And now the new HNI concept, the family offices, institutional investor, they all are emerging in this. So traditional investment opportunity, FD, mutual fund, equity, ETF, rate, InvIT, they are saturating and they become some volatility is there. So investor want to seek differentiated, uncorrelated return, and they want to put the new creative new X in the basket. So in case there is some disaster or some problem, it can leverage this. Now, it is not that AIF globally it is taking new dimension, and this is a new vehicle where people want to expand their portfolio diversification. Till now, SEBI introduced AIF in 2012. Till now, that time when the SEBI introduced, only 42 AIF was registered. Now today is more than 1,200 AIF registered with lakhs of lakh crore rupees under management. It is, we can understand how the growth is taking place and trust is building up. And in my opinion, if I see the journey of last 13 years of AIF, it is, the word is alternative, but it is no longer anymore alternative. It is becoming core strategy, a tool for portfolio design. So whenever you talk to any family office, they are readily, happily investing other instrument like AIF. Now, the AIF are privately pulled investment vehicle governed by SEBI, and it is a sophisticated investors domain. Like, it is not that retail investor should come with 10,000, 1 lakh rupees, because here the commitment size is 1 crore rupees, and beyond the public market it is happening. Second is the AIF, when it is creating evaluation, VC fund to diversified vehicle and including private equity, structured credit, distressed asset, all things which other instruments, other structure cannot do, they are doing. So they are doing as a private equity also, an unlisted company in the private and the startup, structured credit they are doing for the companies, is distressed asset they are buying and then investing. So the key objective is long-term capital with high growth opportunity, which is not available in the traditional market. But it is a risky also because liquidity is not that effective that other, but because investment is based on the agreement, understanding, so they work on various parameters. Now, India has 3 types of AIF, category 1, category 2, category 3, that the other speaker will tell you in detail. But I'll just tell you, the category 1 is always encouraging economic development because they invest in infrastructure, SME, and social venture, startup, early stage investment. Category 2, that is always focused on growth stage investment, private equity, debt fund. Category 3, which is always taking high risk profile and leveraging, they invest in hedge fund and complex strategy that other people are not able to understand. So the investment strategy and risk tolerance is the main criteria and main differentiator in this sector. Now, who can invest? The sophisticated, which I told you, 1 crore rupees is the amount. and it is suitable for HNI, family office, institutional, accredited investor, those who have a longer horizon and they are not bothered about the liquidity and risk. They are risk perceived, they can do it. All these things in detail, the respective speaker will tell. Now the question is, what are the benefits to invest in AIF? One is access to exclusive high growth opportunity like private bank, private companies, infrastructure, structured credit, that is always giving higher return. Diversification is also there. Customization, the AIF can make customized theme and duration of fund, capital breakdown, all these things they can do. Professional management is there because it's managed by professional people and not with a big team. So you have a one-to-one person relation also. And the most important, tax efficiency, especially in pass-through structure like category 1 and category 2, which other Shivanshu and Sanchit will explain to you. Now, investment in asset, investment strategy and asset class is what? AIF, they do diverse strategy they follow. Like VC invest in startup, P invest in commerce, consumer and infra company, real estate, structured debt, distressed asset play, long-term strategy and credit arbitrage, theme-based ESG, tech, clean tech, digital transformation. All these things are there, which are the investment strategy they follow. Now, if you see this, there are four things available today as an investment vehicle. One is the AIF, mutual fund, PMS, and REIT. So the AIF and the PMS is always for the high HNI. Mutual fund and REIT, the normal investors can also invest. Minimum investment in AIF is 1 CR, PMS is 50 lakh, and mutual fund and REIT, it is mutual fund is 500, or now they are coming out 100 rupees coupon also, and REIT 10,000. Liquidity is AIF and other most illiquid is there, but mutual fund and PMS is moderate. Mutual fund is highly liquid, and REIT is also moderate, and if listed, it is fully liquid. Customization you can do. Maximum you can do in an AIF. Mutual fund is very low because this is governed by the mutual fund manager and the organization. PMS you can do moderate, where you have to invest, what are the things you can work out. REIT also you can't do much changes. In asset class, in this, the AIF is privately unlisted and structured, they invest. Mutual fund only listed company, and the PMS mostly listed, and REIT, real estate and infra company they are doing. So this is the slight difference of four instrument which investment vehicle I have suggested. Now, what are the emerging trend in future outlook in AIF? One is thematic fund, like in mutual fund, we have a sector-based fund. So AIF will also come. Today we are seeing majority is a general, but slowly it is emerging. Private credit boom because bankers cannot provide fund on all types of things. So they are coming out as a credit, private credit structured also. Green finance like ESG AIF can give in more popularity getting, and they are investing. Digital transformation is also taking because AI in due diligence, blockchain in fund, admin and tech-led portfolio they are doing. GIFT City IFC is becoming hub for foreign capital inflow by offshore AIF. So that is another opportunity. SEBI is also regulating these things. They want to focus on risk, valuation norms, and side letter disclosure and leverage control. Accredited investors will also be part of this because new class of expanding access while maintaining stability control. So that is also a new things is coming. And there is a projection that AUM of AIF will grow from 10 lakh crore to 30 to 40 lakh crore within 5 years. Now the question comes, what is the future of AIF in India? Moving from niche to mainstream, because today it's a very specific fund, but tomorrow it will focus on each investment vehicle, blurring lines between domestic and international alternative via gift, city, cross-border LPs. Expected rise in institutional participation like pension fund, insurance firm, sovereign and wealth fund. They will also invest in this. Then come to the SEBI's dynamic regulatory, because they are also changing continuously. They're making Indian AIF more competitive and safe and global attractive. That's why they always working out the new changes. India is likely witness next era of AIF through tokenization, AI driven, with global structure and Indian-centric mandates that will come. If you see the international experience and leveraging and learning what we can do, US and EU alternative investment fund makes 20 to 30% of institutional portfolio. Then they have a sophisticated model like co-investment, direct LP access, AI in due diligence, and mature. They have done lots of work. So Indian AIF market should learn. Private credit is also booming in the West. India is adopting fast via category 2 and 2 AIF. ESG first investing in climate impact fund are surging abroad. And simultaneously, we should learn the lesson from international experience also for India. Number one, avoid over leveraging, strengthen risk control, ensure transparency and frequent communication with the investor, which these people are following. So global trust in Indian market will grow only when we will follow the transparency and the control and system which are there. These are some certain points. Now, if I see that role of AIF in nation building, that is also happening, because I just told you the funding in startup, infrastructure, MSME you are doing. And they create a private market counterpart to public market financing to national growth, because sometimes the bank institution has their limitation and you have some project, some idea, something, and where you want to get fund. So they can come out a structured plan. The most important thing is there, the need of investor education. People want to invest. Many HNI, they are not aware of AIF functioning, how they function, how they can leveraging your portfolio expansion. Firm and performer must conduct investor awareness program, like all SEBI regulatory body and the agency, they must do something for popularizing this. Tech and transparency is a differentiator. So tomorrow, when you want to grow in this market, then you have to utilize the tech. You have to be more transparent. And if you're not following this, then it will be a problem. I was just seeing the data up to 31st March from SEBI website, that in category 1 AIF, 89,000 crore commitment is raised, and 49,000 crore fund they have raised, and investment they made of 42,000 crore. That you can understand. And this is on various category: venture capital fund, the investment, the infrastructure fund, the investment, the angel fund, and the special situation fund. So social impact fund, which is allowed in category 1, investment made, SME fund. So all these things are there, which people are doing. Then category 2, which is most popular in India, and majority registration is taking in category 2. They have raised 10 lakh crore rupees commitment. So you can understand the size of the market. They have raised fund up to 3,66,000 crore till now, and in investment they have made 3,32,000 crore. So you can see the market size and things, and it will grow. And if I can do the market capitalization of this, it will become very large. Okay, because market capitalization is always connected with a listed company, but on the valuation basis, if you can do, the amount will become very huge. In the category 3, which is less popular as compared to all three, because it's a sophisticated hedge fund and it is not for every type of thing, and they have a more restriction and more leveraging also, and those who are having the expert knowledge, they can do and they should invest. They have raised commitment up to 2,29,000 crore till 31st March, and they have raised fund 1,47,000 crore. They have raised the fund. Now you can understand the overall market size is 13,49,000 crore, 5,63,000 crore they have invested. They have raised fund and 5,38,000 crore they have invested. Now, dominance of category 2, which I had told you, the growth in category A is also taking very high shape, and because of passing of other things will also making them attractive. And category 3, because it's a very dynamic instrument that is happening and that will take things. Now, if you see the high growth opportunity in AIF, it is what is this? You can invest in a startup and early stage venture, which a listed market cannot provide you. Private equity in growth stage companies you can provide, which is growth, and like BOT, the Mamaearth, all these pre-IPO, they have raised fund and investor has got a lot of money they have made. So many P fund they have invested and they got huge benefit in Swiggy and Zomato. Real estate development project, that is also AIFs are investing and they are creating that listed company. Mutual fund or it cannot fund land acquisition. So before making any building and structure, you should have a land, and for land acquisition you require fund. So they are working out. Distress asset or special situation fund, that is one example. Like so many insolvency companies are there, and category 2 is aggressively working on this. Structured credit deals are taking place, that how the debt deal or mid-size infrastructure firm, tailored repayment terms and higher yield backed by asset securitization, that is also there. Nation thematic sector, like in climate tech fund in category 1 and 2, that is also taking electricity, electrical mobility, charging station, battery recycling. These are the new things which are coming and doing this. So friends, you can understand I have explained to you the entire gambit, the future aspects and the size of the fund and how these funds can modify, they can create customization and other things. Now, it's a turn that you will learn from other speakers. Akanksha, can you, Anushka, can you show the first slide?
Just a second, I'll just.
No, key agenda and webinar, but yes. Okay, so today the entire presentation the other people will give. So you will get the depth knowledge of evolving global HNI landscape, shifting trend, strategy, changing face of wealth in India, where AIF fit in their wealth strategy, introduction of AIF, historical evolution, AIF strategic wealth creation tool, different category of AIF, formation of AIF, legal side, future outlook of AIF, concluding focus on key takeaway from the webinar of this. Next. And the evolving global HNI landscape, shifting trends, the strategic allocation that is there, that they will do. So only thing is the HNI globally crossed 23 million in 24 and total wealth is exceeding 86 trillion. That globally it is happening. So you can understand 60% new HNI are under 50 with rising portion for tech, startup and digital, because there's a new age fund. Significant wealth shift is underway, estimated 15 trillion in international transfer expected next decade. So these are the things, and I will request Sanchit to take up the next the portion on this. Over to you, Sanchit.
Thank you. Can you, the admin, can you just stop sharing? Yeah, and share the screen. Yeah. Thank you so much, sir, for giving me an opportunity here. So it's a pleasure to welcome you all to this important discussion on alternate investment funds, unlocking strategic wealth creation. Um, Before we dive into the specifics of yeah, before we dive into the specifics of AIFs, let's take a step back and let's look at the bigger picture. Uh, the global and the Indian high net worth individuals, which are the HNIs, we look at their landscape and how it is evolving in ways that are fundamentally reshaping the capital flows, the investment preferences, and the wealth structuring across the world. The story of wealth has been always been a story of change, and today, as we stand at the cusp of the new era, that change is faster, broader, and more profound than ever before. So let's start with the global picture. So in 2024, the number of high net worth individuals, those with the investable assets of over $1 million, approximately 8 crores, surpassed 23 million globally. Collectively, these individuals now control more than $86 trillion worth of wealth. But here's what's more interesting. Over 60% of the new HNIs are under the age of 50. A significant portion of this wealth is being generated not by old money, but by new capital, tech entrepreneurs, startup founders, crypto innovators, and first generation industrialists. And we are in the middle of a $15 trillion intergenerational wealth transfer that is poised to reshape how this capital is deployed and going to be managed in the next decade. I think this is just not a numbers game. I think it's a very structural shift in how, why, and where the wealth is being created and moved. So the key investment trends among the HNIs are on the rise. HNIs are allocating almost 25% to 30% of their portfolios to Ps, VCs, and AIFs. There's a sort of purpose-led investing that is going out today. ESG, impact, and sustainability are now very mainstream for the next gen billionaires. Uh, with the globalization in place, there is a lot of global diversification that is there amongst the key investment trend. They are looking beyond borders, international AIFs, cross-border VCs, REITs, all of that. A lot of investments are going towards tech-driven AI, blockchain, biotech founders, which are shaping new wealth centers, especially in Asia. A lot of wealth is being also concentrated in these new, densifying the new global financial hubs, Dubai, Singapore, New York, Mumbai, and the rise of family offices. HNIs are setting up single, multi-family offices to professionally manage their wealth. I think let's move towards the changing face of the wealth in India, because let's come closer home and let's look at it from the Indian landscape. India today is not just participating in this wealth revolution. I think India is driving it. As of 2024, India is almost home to 8.5 lakh high net worth individuals. We have more than 160 billionaires, and we are also expected to add more than 100 more by 2030 by Credit Suisse and Kotak Wealth. And this wealth isn't restricted to the Lutyens or the South Bombays of India. It's also flowing from the tier 2 cities, Rajkot, Surat, Kanpur, Raipur. All of these tier 2 and tier 3 cities are also bringing in a lot of wealth from digital entrepreneurs, D2C brand builders, SaaS-based founders, and even creators in this new digital economy. Behind this wave is a powerful combination of tech entrepreneurship, uh, financial services boom, family businesses expansion, startup exit, and yes, a maturing capital market that is rewarding those with conviction and consistency. I think How HNIs traditionally invest, I think we would be looking at what was the then versus what was now. Uh, in the traditional portfolio earlier, let's contrast this with the past and the present. And earlier, the typical HNI portfolio in India was a cocktail or a mixture of real estate, fixed deposit, uh, gold and jewelry, and maybe a few stocks or mutual fund, listed equity, direct or via mutual fund. But today, uh, the portfolio looks dramatically different. 20 to 25% almost goes into private equity or venture capital via alternate investment funds. 15 to 20% goes into credit and structured debt strategies. Almost 10 to 15% goes to long short category AIFs for tactical alpha, and a lot of increased allocation to offshore funds, global investing, co-investment platform, direct startup investments. I think the shift has been uh, driven by, I would say, five core things what HNIs want today. Number one, higher alpha. Now it's a very newer term, higher alpha. Um, Traditional returns don't excite the HNIs anymore. Uh, Traditional asset classes have offered very limited post-tax returns, and HNIs are very much hungry for non-linear or J-curve kind of upside. So I think higher alpha is a very much thing that HNI wants today. Second, professional management. They really prefer curated, research-backed investments by a seasoned fund manager over DIY investing. Probably research-backed thesis or investments which are driven by a lot of research behind it. So I think professional management is the second want of theirs. Third is diversification of portfolio. I think exposure across sectors, asset classes, geographies, instrument is something of their demand. Fourth is tailored solution. I think HNI seeks bespoke structures, like such as feeder funds, to co-investments, to custom vehicles. I think they are also even setting up their own AIFs for this thing. And last but not the least, tax efficiency. I think what kind of post-tax returns they're getting from the different asset classes and their structure is what exactly their requirement is. So let's look at from the point of view of what exactly the kind of preferred investment vehicles that HNIs are looking at. I think HNI today's are not bound by conventional products, and somewhat their toolkit looks like the alternate investments, which is private equity, venture capital, fractional real estate, P2P lending, all managed by sophisticated professionals who understand niche needs. So I think alternate investments are something very much likely that an HNI would be interested in. The second is a portfolio management scheme, which offers flexibility, sectoral focus, customized portfolio construction of this equity segment that a HNI would be interested in. The third would be market-linked debentures. I think MLDs, index to market movements, offering structured returns with controlled risk, is something that they are really looking at as an investment vehicle. Uh, Fourth is real estate funds and REITs, especially in commercial real estate, which is now outperforming residential in both yield and appreciation. So real estate funding and REITs are a very great preferred investment asset class. And fifth, something of very of utmost importance, the angel investing and the unlisted equity space. I think direct participation in startups, often with portfolio diversification across 8 to 10 companies to manage volatility, is something that the HNIs is today really looking at. I think the message is very clear. Today's HNI doesn't want cookie cutter advice. They want really strategy across different asset classes, which gives them a higher alpha and a J curve. How the family offices of these HNIs are leading the trend. So let's look at, if the HNIs are the early adopters, then family offices are the institutional innovators. I think over the past 5 years, India has seen a 6 times rise in family offices, many structured as multifamily offices to pool resources and access premium investment classes. These offices aren't just investing, they are syndicating deals, building custom AIFs, and participating in cross border VCs and PE. They view alternative investments as tools for long term alpha in venture and private equity, stable yield in private credit, tactical hedging via long short strategies. The bar has been raised a lot, from advice to insight, from products to platforms. I think these family offices are really setting up newer heights of investing in different asset classes. HNIs today are no longer passive investors. Uh, I think they are a lot more institutional in nature. Today's HNIs is not passive. They behave like institution. They demand quarterly updates, alignment of the management, transparency. They ask really tough questions. They want bespoke reporting, expect the management to have skin in the game. Uh, I think many are limited partners in AIF, VCs, and people, not just bringing capital, but networks, co-investments, interest, and sectoral expertise. They are no longer just clients, they are partners in capital formation. Amongst all of this, I think, where does the alternate investment fit in the wealth strategy? All of this leads to one conclusion, is that AIFs are not a niche anymore. They are now core to wealth strategy, wealth creation, especially for the ultra high net worth individuals who get their portfolio professionally managed. The typical portfolio allocation among India's top family offices includes almost 20 to 25% in Cat 1 and Cat 2 AIFs, especially in the consumer, infra, fintech, growth equity, almost 15 to 20% in credit structured debt, which are yield focused for AIFs. Almost 5 to 10% goes in long short category 3 fund, which are used as various tactical alpha engines. Why? Because I think AIFs offer three things: access to themes which are not listed on the stock exchange, alpha that is difficult to replicate in mutual funds, and structures that are tax efficient and flexible. I think both of these three things brings us to the introduction of what exactly alternate investment funds are. I think what we are witnessing is a very exciting transformation in the private capital market, driven by empowered investors, deep research, innovative structures like AIFs. We are no longer talking about just managing wealth. We are talking about strategically building it, preserving it, and institutionalizing it for the next generation. AIF, or alternate investment funds, when chosen wisely and managed professionally, are one of the most powerful tools in the mission of creation of wealth. I think moving forward, we would be looking at what exactly an AIF is. So, AIF is sort of a pooled investment vehicle that collects fund from investors for investing in different types of assets. The regulation says that AIFs are regulated by the Securities Exchange Board of India under the SEBI AIF Regulations 2012. As per the definition, as per the law, any fund established or incorporated in India which is a privately pooled investment vehicle which collect funds from sophisticated investors, HNIs, whether Indian or foreign, for investing in accordance with the defined investment policy for the benefit of investors, is what an alternate investment fund is. I think we will just say what AIF does not include. Any fund covered under the SEBI regulations for mutual funds or collective investment schemes or any other regulation of the board to regulate fund management activities doesn't include that. It is sort of a privately pooled investment vehicle which collects fund from investors. So how do the pooled fund works? If you look at the chart here, the first and the foremost process is money of the investors are pooled together in the fund, which is managed by a professional fund manager. The fund manager then invests that respective pool of fund in various securities. Those securities generate returns which are given back to the investors. That is a simple way of how a pooled investment vehicle works. Why AIF is the need of India? I think bridging funding gaps is primarily the first thing that why AIF is the need. It provides essential capital to startups, infrastructure, and undeserved industries. It really fosters entrepreneurship, supporting MSMEs to drive innovation and job creation, long-term capital supply. It enables sustainable growth through patient and long-term investments and infrastructural development. It drives investment in critical projects to boost economic growth. I think we'll move towards the historical evolution and the growing story of what exactly and how an AIF started off. It started back in 1988 when the Indian government issued the AIF guideline marking the beginning of alternate investments in India. Then followed by 1996 when SEBI introduced the SEBI regulations of venture capital fund, expanding the scope of venture capital investments. In 2000, the tax incentive were introduced for AIFs and the SEBI regulations were revised accordingly. 2003 started a surge in offshore funding and backing domestic ventures. From the era of 2001 to 2007, we saw first landmark PE deal of Warburg Pincus investing $292 million in Bharti Televentures and entry of global players like the KKR, Blackstone, Actis in that era. I think 2008 was a global financial crisis, so that what slowed down and the momentum of the PE and AIF, but it picked up very fast. And 2012 marked the introduction of AIF regulation for formally institutionalization of India's alternate investment industry. 2016 created new opportunities in stressed asset financing, and 2020, the rise of specialized AIF themes brought sectoral diversification, advanced strategies like derivatives and merger arbitrage, increased domestic participation, tech-driven investments, and SEBI's allowance of performance-based fee models. I think I'll move forward. I'll pass the presentation to Shivanshu. He's the founding partner of Market Capital, which is a Cat1 alternate investment fund. We'll be talking about how AIFs is like a strategic wealth creation tool.
Thank you so much, Sanchit, for the introduction, and Pawan sir for overall giving us that visibility and for inviting us to this webinar. So let me just share my screen and please let me know when it's visible to all.
Visible.
Sure. Okay. So Sanchit talked about, how the AIFs, the historical part of AIFs, and how they, even today, when we talk to the regulatory authorities, we are working in tandem with the authorities, and new regulations are coming in to make AIF as an ecosystem much more fragile, much more robust, plus include, more avenues. How can the gaps that we have identified earlier, that we talked about earlier, can really be addressed? And AIF as a strategic wealth creation tool specifically for good amount of family offices, UHNIs of the world has been tremendous. So let's talk about what actually AIFs bring to the table when it comes to a wealth creation part, and what makes AIF a distinct investment vehicle per se. So first point is they provide high flexibility. Okay. So as we talked about, there are different categories of AIFs, category 1, 2, 3. And within those categories, there are subcategories, right? So for example, you as an investor might be interested in certain opportunities, early stage opportunities, or maybe late stage opportunities. So you will have some AIF or the other for your chosen investment theme that you think would outperform in the coming times. So, for example, in 2015 to 2020, D2C was a good theme, right? That investors followed earlier with the rise of Mama Earth, Boat, etc. So many startups. But in today's day and time, D2C could be a bit, investors are moving away from that theme and moving towards maybe electric vehicles, solar, etc. So themes keep on changing, and I think these investments, so there are particular funds who focus on certain themes which you can pick, and they can provide you high flexibility in that regard, specifically for your portfolio. Second is targeted focus. As we talked about, there are specialized in sectors. So for example, maybe you have 100 crore portfolio, very hypothetically, maybe 50 is parked in a FD, 25 is parked in equities directly, and maybe 10 or 15 crores you are parking for, specific bets that you would want to take. Maybe you are very pro EV or guy, or maybe, in a defense sector theme, etc. You can obviously take some exposure at a later stage when the companies have already IPO'd. You can take them on the listed exchange. But for example, if you want to have some exposure in these startups, right, in the SME ecosystem, pre-IPO opportunities. So these are all the investments that can be sourced through an AIF, right? And what do AIFs actually bring on the table? It brings on the table a particular fund manager who have had the experience of making those investments, doing the due diligence. And then also one of the most important part is deal sourcing, which many HNIs and family offices can't really do. So that's what AIF brings to the table. Third is attractive to HNIs and institutions. When we talk about certain category of investors, 1 CR is the minimum that you will have to invest when it comes to AIFs, and I think that is done because AIFs are sophisticated tools, right? And when if retail would start to participate, they wouldn't be guessing where their money is actually going in, and what are the really associated risks with investing in the AIF. And even the taxation is pretty simple for category 1 and 2 specifically. It's a complete pass-through structure to minimize the double taxation. And then diversification, as I talked about, example wherein you already have a larger portfolio, but you would want to diversify into certain maybe early stage bets or maybe pre-IPO bets, right? So it helps as a very, a good mechanism to at a very broader level. And when we talk about even equity side of things, we should also touch upon debt side of things, wherein Cat 2 AIF, there are certain funds who do private credit, okay, and even real estate investment trusts, InvITs, right? You can diversify your portfolio in many ways, and economic growth. I think this is a very less talked about point, but when in 20 after 2014, we have been very startup focused economy, right? You as an individual investor, no matter how much money you would have, but there will always be a limitation of deal sourcing for you as a investor, right? And AIFs become those vehicles which takes money from people who can invest, and promoters, founders who actually need money to grow their wealth, right? And I think that's the economic growth happening right there. Maybe later in these slides we'll also cover an example of Zomato, right? Maybe it's a top 30 listed firm in India currently, right? And maybe we wouldn't have seen Zomato where it is today if it is not for the VC or PE funds which backed Zomato, Dipender, since 2009. So that is how economic growth is happening. Potential returns, obviously, when we talk about higher risk, there is also a higher reward attached to it. As an investor, you will have to gauge. I won't say every AIF is profitable, every investment class is, doing just fine, but you will have to gauge your own risk and reward ratio. But this category, AIF category, specifically category one and category two, uh, pro- category one VC funds, angel funds, category two PE funds, or category three hedge funds. Obviously, they are lying on top of all the other asset classes when it comes to risk and reward ratios. As I was talking about, if we see what are the risk and return profile of different asset classes, might not be the best to consult on a on hardcore numbers, but when we talk about VC or PE funds, there are so many risks that are involved in a business, right? So it could be business risk, macro risk, micro risk, or in this case, specifically in case of AIFs, a lot of liquidity risk is also involved. And the businesses, specifically when it comes to startups, can go bust or it even can go 100x. So returns could be very, very skewed in a AI, in particular AIFs. Obviously, there would be certain AIFs that would be more stable, maybe backing companies which are at more stable stage, or maybe doing just debt. So not to underwrite all the AIF structures, but certain AIFs might be very risky in that regard, which comes above all the direct stocks, PMS, equity mutual funds. So that way. And if we talk about, how I think we have already gone through this, but in the last 6, 7 years specifically, the AIF industry has gone from, just 1 lakh crore in commitments to now 7 lakh crores in commitments, which shows how much potential the AIF as a category has. And this is also backed by the fact that the regulatory bodies would want certain asset classes to be, backed by AIFs as well as other qualified institutional buyers more. Maybe Manoj sir will discuss it later when we talk about IPO side of things. And what it does is, because fund managers are very thorough people, right? They are managing money for hundreds of people. So it is expected out of them that they'll do their due diligence and etc. Right? Which is not expected from a retail investor per se. And hence regulatory bodies would want in certain assets, QIB should be participating in large numbers. And even IPO is one of those categories wherein SEBI would want 50% of the IPOs to be underwritten by QIBs. And moving forward, these are the top VC firms. I think now will become a lot more relatable to most of the guys. When we talk about VC firms, so venture capital would mean maybe they are backing companies. So if we have talked about it earlier as well, angel funds would be the funds which are mostly the first checks in the company, backing a company at an idea level, right? So Anycut is a good example of that. And then VC firms are mostly the backing firms which are seeking a maybe pre-series A to series S, even series F or series J in certain cases. So they are already companies who have established product market fit, right? For PE firms, these are mostly the firms which are now very mature. The companies are very mature and might be eyeing IPOs in next 2 to 3 years. And that's where, KKR, Carlyle Group, Blackstone also come in. And the hedge funds are, I would say, very opportunistic funds. Wherever they find any arbitrage opportunity or maybe any value that has to be, created, hedge funds look after that. So that's a very broad classification. And these are all the examples of top VC, PE, and hedge funds. Top performing AIFs in India, for just to give you a context of what the returns could look like, right? For Abacus Emerging Opportunities Fund, for 5 year return has been 34.3%. Right. I won't say it's top of the class, but but in the PE category, it's pretty handsome. It's run by Sunil Singhania ji, and the kind of companies that he backs. So it's overall, as an investor, you are backing fund managers' philosophy. For example, if you're backing Abacus Emerging Opportunities Fund, you're putting your money in this fund. You are backing the philosophy of Mr. Sunil Singhania, and you trust him with your money that he'll be putting those, that money in companies which have higher growth potential per se. And also we'll discuss how the AIFs are different from mutual funds. And that's how I'll tell you it's more about the AIFs are more about taking a bet on the fund manager rather than the actual investments. Because once you commit to a fund, you won't see, you won't be having any control on where it is invested, but you are trusting your fund manager that he'll be doing good amount of due diligence, deal sourcing, etc. to place your funds. Specifically in April 2025, approximately 110 out of 123 AIFs in the PE segment have posted a positive returns for the month. It starts from maybe 8.6% in a month by CCV, 8% by Arth AIF, Alchemy 6.4. So it's just for us to a way to benchmark and maybe give you a flavor of how the returns could be. As earlier we were discussing, Zomato is one of the examples that I try to quote a lot because it's a journey, it's a company that we, as millennials, have seen, build right in front of us from 2008. Dipender. I still remember in 2008, I think I might be 14, 15 years old when we were seeing, to check a menu of a company, you go through Zomato, right? And now the scale that is achieved today by Dipender and the team. It has been tremendous, right? And that's why I really focus on how AIFs have really created this ecosystem of backing amazing founders, including the likes of Zomato, etc. If you see this chart from 2nd July to 22nd Feb 2021, Zomato did more than 15 plus rounds of investments through AIFs. And if at any point of time they were not backed by a AIF or certain institutional investors, they might not have been existing in the capacity that they are today. So that's the economic growth aspect that I would want to touch upon. And Info Edge was one of the prime investors. They have invested in each and every round of Zomato. They have cumulatively from start to the end, put in 147 crores in Zomato. Now they own approximately 13% of Zomato, but their stake is valued at more than 30,000 crores, right? So it's a return of more than 200x, and that's the disproportionate returns that I talk about in certain AIFs. Now talking about the challenges that comes with AIF. Obviously, because these are very regulated, highly regulated vehicles, it's not, I won't say if it's even easy to get a license to run a fund, because you need to have a very high bar for a fund manager, and all the regulatory compliances have to be met. So AIFs come with a very high regulatory complexities. You have to comply with stringent regulations by SEBI. There are so many tax related requirements, etc. And then the other challenges could be sector specific risk, right? When we talk about you diversifying your portfolio in certain assets, it might be a different way of saying this also, right? What if that sector doesn't work, right? What if that, for example, if you're backing a certain sector in maybe say D2C at current juncture, it might not work well, right? So it's a very sector specific risk also, because as fund managers, you might be expert in certain sectors, and you might be, placing your bets in those sectors, which might not work in your favor. And the third is liquidity constraints. Not all AIs, I would say. For category 3, there is a concept of open-ended fund as well. So you might not be able to exit maybe for a year or two, but after that it could be liquid. But specifically in case of a VC fund, angel fund, or maybe a PE fund, the investment horizon could stretch a lot, right? For example, if you're backing a company, the exit route might be planned for next 3 to 5 years. In certain cases, PE funds have a life of more than 10 years as well. So a liquidity could be a good constraint, which also doesn't work in favor of smaller investors. Only large ticket investors are able to set aside some money for these kind of AIFs. I think this is an interesting point when we talk about mutual funds, PMS, and AIF. So mutual funds and AIF have one thing in common. You as an investor doesn't have a say in where the money goes. Okay. And obviously, both the mutual fund is a collective investment scheme, and AIFs is also a pool investment vehicle. But for mutual fund, it's more about retail investors, which can come in at a size of maybe 100 to 500 at the smaller scale. But for AIF, it's 1 CR. Specifically, as we discussed, three categories. Only one category, which is category one and subcategory of angel fund, can raise a minimum investment of 25 lakhs. Other than that, all investments are 1 CR. Maybe for investment in distressed assets, the minimum size is 10 CR. The portfolio type for mutual funds could be equity, debt, money market. And for PMS, it's usually direct equity. The one benefit that you can enjoy in PMS is higher liquidity. You will have a dedicated portfolio manager, and your portfolio could be managed very separately because your risk and return profile could be very different from other investors. So PMS provides that flexibility that you can enjoy, and you can you have your portfolio according to your risk and return profile. But for AIF, it's a blind pool structure. Once you commit to a particular fund, you don't have a say in where the money goes. Obviously, the thesis is underlined in the PPM where the AIF would be investing in, what could be the possible return scenarios, etc. But you don't have a say in particularly which companies the fund manager would be backing. Investment horizon for mutual funds could be short to long term. PMS also medium to long term, and AIFs is mostly long term, but could be medium term as well in case of opportunities which have exit planned maybe in a year and a half. Risk management, mutual funds are usually diversified. If you see even quant fund, which is the least diversified mutual fund out there, it has 25 companies in its portfolio. And if we go to ICICI and HDFC, they have more than 60-70 companies in their portfolio usually. And fund manager for mutual fund, it's a dedicated professional fund manager, and for PMS and AIFs as well. Moving on. Now let's see what is the future outlooks for the AIFs. Okay. So as we discussed, there are three categories. Category 2 is the heaviest category, wherein more than 9 lakh crore in investments or in commitments has been raised. And when you see, category 1 is more about startups, early stage companies. Category 2 is more about investing in companies at private equity level, right? And the third would be the hedge fund category, which is the category 3, wherein you can do anything. Or whatever you can do in 1 or 2, you can do in category 3 as well. But category 2 has been the most prominent because you have that flexibility to do debt as well. You can't do debt in category 1 and category 3 as well. So because there are a lot of complexities involved in category 3 taxation particularly, so category 2 is go-to choice for many fund managers per se. And these has been the themes that we have picked up. So a lot of AIFs have been coming in, which wants to cater to the need of family offices or high net worth individuals who would want to explore the theme of ESG investments, right? For renewable energy, waste management, impact driven ventures. So a lot of AIFs are coming in that regard. And even in the space of disruptive technologies as AI. So for example, me as a investor, we at Makia, we usually invest at pre-IPO level. We have our set target base. But when it comes to investing in AI, I might not be the best person to gauge what are the metrics that I should look for. But if I would want to really place my bets, I would want to diversify my portfolio in the AI segment particularly. I'll look for fund managers who have expertise in that particular domain. So that's how I see AIF as an ecosystem. And there are traditional investments. You as a particular investor, you must be investing in bonds, you must be investing in FDs. Real estate is a go-to asset class for a typical Indian HNI family, and even stocks for that matter, right? You might be relying on certain tips. You are doing your trading in mutual fund. Oh, sorry, not trading. You are investing in mutual funds, SIPs. But beyond these traditional investments, there is a asset class, AIFs, which provide you with very different kind of investment approach, which you might not be do on a very individual basis. Uh, and when I see how the ecosystem is evolving, particularly, so we have seen enhanced confidence. So you must be wondering, hearing from me and Sanchit, we can place a bet on fund managers, we can place a bet on, but the overall thing is the structure is such that there is so much enhanced confidence, right? AIFs have continued to mature. The kind of regulations that have come up have been very transparent. You can easily benchmark performance of different fund managers, how they have performed in the past, what is their track record, which is a very important aspect for you as an investor to gauge as well. Second is sectoral growth. So there have been certain themes that have been prominent in certain decades, right? And for example, as we talked about, 2015 was more about D2C. Currently, it can be more about energy, power, defense, infra as well, right? With government focus coming in. So obviously it could be very qualitative. We all read many things, and our vision of how the world is gonna be could be very different, and hence even the sectors would be growing. The sectors that we would want to take a bet on can differ for me as well as you as an investor. So you can choose your own bets when it comes to sectoral growth. Innovation, so there is a growing trend in AIFs to have funding for disruptive technologies, and I think it's very important for us to back these AIFs, because these are the AIFs which will in the end back companies which will go on to become maybe top 10, top 20, top 30 in the world globally, and have a name for us as India going forward. And the policy reforms, I think, have been very instrumental in, increasing the AUM in last 7 years, as we talked about. In last 7 years, 7x in commitments, right? So regulatory reforms have been tremendous when it comes to, simplifying all of it, the complexity. So there have been new, fund managers have to be at certain caliber to be eligible to even open a fund, right? There has been enhanced in tax clarity specifically for Cat 1 and Cat 2 AIFs, because the focus is more on the economic growth aspect of it. And then obviously focus on innovation, which is tremendous. And then I'll just take a moment to introduce Makia Capital. So me along with Sanchit are the founding partners at Makia Capital. It's a Cat 1 AIF venture capital structure, and we do a lot of as corporate professionals is into merchant banking side of things. So it was pretty much a natural extension for us to open a Cat 1 AIF, which focused on backing companies who would want to explore the IPO route in coming 1 or 2 years. And we try to back them at a very early stage, maybe at a pre-IPO stage, or maybe in certain cases do anchor investments as well. So yeah, that's what we have been doing, and would love for Manoj sir to pitch in and hear his views as well.
Thanks, Ivansu. So I think it is a very interesting discussion. I think, can you bring down the presentation? Yeah. So alternate investment funds, the law has come. Sanchit has
Presentation का change करो. Next slide करो भाई.
नहीं, कोई जरूरत नहीं, slide नहीं है सर. It's okay. I'll discuss. Just need to be brought down. So basically, we are discussing about the alternate investment fund, and it is a very unique kind of structure which has come out, and which is growing very fast. So earlier, as Sanchit was giving the whole timeline over a period since 1992 or even 1988, the first guidelines came from SEBI for alternate investments, and then it became more of a venture capital registered with SEBI, and the FII registered with SEBI, who are investing in the capital market. So that growth journey has changed over the period of time when the law relating to alternate investment funds came in India. And since 2017, there has been a tremendous growth in this market. So in 2017, I think the total commitment size for all the AIFs was only maybe less than a lakh crore rupees, but which has now grown to around 14 lakh crore. So it has been a tremendous jump. Similarly, there has been a huge jump in the number of alternate investment fund registered with SEBI. Around 1,400 funds are already registered in India, which are in three categories, which Shivanshu has given in detail. So yes, it's a new opportunity where sophisticated investors, large size investors can participate in the growth of various businesses. So there are different themes under which different AIFs make investments. All are obviously focused on taking some theme. Sometimes it is a targeted investment, sometimes it is purposeful investment like sustainable growth, green energy, etc., etc. So those are the broader theme through which investments are being made. And if individual, let's say one HNI which has a capacity to invest 1 crore to 5 crores, want to participate in the growth of some venture which is in green energy, he may not get right target or may not get opportunity to invest. However, if he can approach some alternate investment fund which is targeting such sector, he can put the money there, and then it will be invested in the right companies, and it will be managed by professionals who are well versed with the industry, who can do the diligence, who can manage the fund properly, who can look into the growth of the company and protect the interest of everyone. So obviously this is the right way to invest if you are targeting a large size of fund to be invested in an alternate manner. So it is an alternate investment opportunity which is beyond the traditional investment like mutual funds or capital market investment management through PMS schemes, or maybe direct investment in real estate. But it has a very wide spectrum where investments happening, and through that it is also creating a democratization of the investment opportunity for HNIs and ultra HNIs, people who are now whose community is increasing in India. So it is basically designed for sophisticated investors who can invest in who want to invest in multiple things. So there are different kind of investment. We have seen that recently almost 3.5 lakh crore rupees are invested in the startups or various ventures through alternate investment funds. Similarly, around 1.95 lakh crores are invested in the private debt. So private debt, and similarly around 75 lakh crore rupees are invested in real estate through alternate investment routes and funds. They are giving quite good returns to the investors from one side. On the other side, they are helping in the development of these companies. So startups are getting fund when they need for the growth of the company. Many companies which are going for IPOs getting fund in the form of anchor investment or qualified institutional investments. Then if they want debt funds, there are various alternate investment funds which are investing in the listed debt securities, NCDs, unlisted debt securities also. So there are large spectrum, and it is very wide variety of investment opportunity which are now getting opened through this alternate investment of funds. So it gives diversification to the investment. It has much higher return in general than mutual funds or maybe FD or other alternate investment opportunity. Then it is giving exclusive access to investment in startups, pre-IPO stages, niche sectors like renewable energy, typically reserved for the big players. Generally, individual cannot get opportunity to invest in such businesses, whereas through the pool of fund, through the right fund manager, these investments are very much possible. And then you have a security that the fund is being managed. Your fund is being managed by someone who is professional, who is capable, who can handle the diligence, who can handle the tax, all tax and other things. which is not possible for individuals, and then that's why there is a growth. If we talk about the investment in a capital market, so alternate investments are AIFs are generally categorized as QIBs, qualified institutional investors, and hence they can invest in the as angel investors in alternate in IPOs. They can also invest in pre-IPO stages, and if they are investing in pre-IPO stage, their liquidity starts early than individuals. So let's say if we talk about an investment in SME IPO, many of the we have seen that there has been a huge growth of SME IPO in last couple of years, and one of the biggest reason for this growth is the investment by alternate investments in the SME market. So many of the AIFs are investing in SME. SMEs are even before they are going for IPO, like Shivanshu was talking about Makia, which is Makia Capital is targeting early stage companies which are going for SME IPO in 1 or 2 years, and they are backing it. So if they are putting money in a pre-IPO stage, the lock-in for their money starts from the very first day when they make the investment into the company. And for all other people like individuals, HNIs who are directly coming in these SMEs, their lock-in would start when the IPO comes. From there, their investment would remain locked in for 1 year. Whereas for AIFs like Makia, it will be maybe 9 months before, so that they will get liquid funds just after 3 months from the date of IPO. So that is one of the biggest reason many of the alternate investment funds are putting money in AIF in SMEs who are planning to go for IPO in a year or so. Similarly, they are also anchoring many of the IPOs, SME IPOs, and if let's say 50% of the fund is already committed through as an anchor, it becomes very easy to get the balance fund from the retail investors, and thus IPO gets easily successful. This money is fueling the growth of the SMEs. We all know that SMEs are very important for Indian ecosystem, Indian growth story, because there are lakhs of SMEs which are in the manufacturing, which are in the growth of the, which are helping in the growth of the GDP of our country. And if they are being backed by these persons, obviously it will help in the longer runs for the growth of everyone. So I think all other things are already discussed in detail. But yes, if you have sufficient fund, you can invest up to 1 crore or more in, and you are not in a position to find the right target, or you are not in a position to professionally manage your fund. It is a right strategy to go to right AIF and invest through that. It will be giving you much better return than mutual funds or PMS, or maybe direct investment in real estate. But yes, you have to understand that there will be a bit of less liquidity, because AIFs are for certain period. Other than Cat 3, all are close-ended funds. So the money cannot be easily withdrawn when it is put. Like in case of mutual fund, you can sell in the real-time basis. That is not the possibility. However, if you have long-term investment goal, you can get very good return. As Shivanshu was showing, there has been many of the alternate investment funds who have given a return of around 30% to many, as an IRR to many people. So I think AIFs are the game changer for HNIs, family offices, and institutions. Those who can take high risk and have a long-term goals, they should pool their money there, and they will be helping in the growth of the economy as a whole. So it is a very good thing. I think most of the things are already discussed. So let's discuss. If there are questions, we will be able to answer those questions in the Q&A sessions. Thank you.
Thank you, Manoj. Thank you. Now, I think Vaibhav has to discuss the. So, Vaibhav, please, can you tell us the type of AIF and how they are different? Very briefly, you just said.
Yes, good evening, everybody. Is my screen visible to you?
Yeah. Yes.
I'll be delving into the process for the formation of the alternative investment fund. And before I go into the process, I'll take you through the few definitions that we need to understand before we understand the process for the setup of the alternative investment fund. So the first definition that I'll focus upon is the sponsor. The sponsor is a person or persons who set up the alternative investment fund. So as if I try to dissect, the definition says that it can be person, it can be an individual, it can be persons, that is more than one individual. And in case of a company, it has to be the promoter of the company. And in case of LLP, it has to be the designated partner. Next important definition is the definition of manager. So manager is the person or the entity who is appointed in the alternative investment fund to manage the investments from time to time. Then comes the private placement memorandum. As in short, people know it is as PPM. So PPM is a document which contains all the details about how the investment strategy of the fund will operate, what will be their target investors, what will be the proposed corpus, and what will be the process with respect to the distribution waterfall, and all the material information with respect to the risks, that includes the material risks or the internal risk or external risk, that is disclosed in this particular document. Now I'll come to the definition of corpus. So corpus is nothing, it includes the total amount of funds which needs to be committed by the investor to the AIF. It includes the total amount of investment that can be done in a particular scheme. So there is a limit that is there written in the scheme of each fund that is incorporated. Thereafter, I'll briefly discuss about the various categories of AIF, as I already know that it has been already covered. So I'll try to discuss this in brief. So category one is the category which primarily focus on the investing in areas where the government or regulator consider it as socially and economically desirable. That means the intention behind creating this category is to ensure that the sectors where there is a need for promotion will get the enough investment so that in the coming times these sectors can be in growth can be increased in these sectors. This can be healthcare sector or possibly the education sector or possibly the road sector, power sector. So these are some of the example that we can quote for this particular category. So under the AF regulations, there are different subcategories that has been divided under the category one. So these includes the venture capital fund. So as the venture capital fund name suggests, so a fund needs to invest at least 75% or more of their investable funds into the early age startups, wherein there is a high chance for the growth potential. Then coming to the infrastructure fund. Infrastructure fund is the fund where the fund has to commit at least 75% or more of their investments into the projects of infrastructure, possibly into the roads, powers, or urban development. Then comes the SME funds. So SME funds, as the name suggests, is the funds wherein the funds will be majorly invested into the small and medium enterprises for their business expansion. So under law, the minimum investment that has to be done in the SME sector in the unlisted space has to be 75% or more. Then comes the social impact fund. So social impact fund is the category wherein the government has taken into account that the social areas or where there is a need to provide investments like healthcare or education, these funds will invest their money into these sectors and get profit out of it. Now comes the last category, that is the angel funds. So angel fund is the subcategory of venture capital fund, and herein the specific angel investor invest their money into the funds, and thereafter they raise funds from the angel investors for their early age businesses. Now coming to the second category. So this is the residual category. So if any fund does not fall in category one or any fund under category three, then it will fall automatically under the category two. So that is the reason it is called the residual category. Now I'll briefly delve into the types of category 2 AIF. So first is the distressed asset fund. So herein the investments are done primarily into the financial distressed companies or into the securities of financial distressed companies, aiming to revive them. so that in future it can be turned profitable. Then second is the debt fund. Herein, as the name suggests, the fund has to be dealt into majorly into the debt structure, wherein the intention is to get the predictable returns. However, the risk in these funds are a bit lesser as compared to the other funds. Then comes the real estate equally oriented fund. Herein, the focus is to invest into the equity funds in the real estate sector, wherein there is a chance for capital appreciation. Then comes the real estate non-equity oriented funds, wherein the non-equity investments are done in the real estate projects to get the steady income in the future. Now I'll come into the category 3 AIFs. So category 3 is a bit complex strategy, wherein wherein the arbitrage trading strategies are employed by the fund managers. Herein, both the long and short positions are used in equities, and multi-asset funds are also created. For here, the risk is very high. So I'll briefly tell you about the types of funds that can be registered under category 3. So these includes firstly the hedge funds. I think this is the most common type of fund under category 3, wherein the hedging process is done for the process for getting the higher returns. Then comes the long only equity fund, wherein the long-term perspectives are taken into account in the equity side for aiming for capital appreciation. Then coming to the long short equity fund, here the both long and short positions are taken into the equities to capitalize the market opportunities. Then comes last but not the least the multi-asset funds. Herein the different classes of assets are taken into account and the investments are diversified to optimize the returns and to reduce the risk for the longer run by the investors. Now coming to the next specific alternative investment fund. So as with time to time, SEBI has the power to introduce new types of funds from time to time. So as per the AIF regulations, Second Amendment Regulation 2023, SEBI has introduced Corporate Debt Market Development Fund. This is a subcategory of the category 1, wherein the intention of the regulator was to provide an institutional framework to enhance the security market liquidity in the corporate bond market in case there is a situation of stress that arises in the market. So this is a very niche fund that has been incorporated under the category 1. Now I'll try to provide you the clarity and difference with respect to the different categories of alternative investment fund. So firstly, I'll delve into the category 1, then category 2, and then category 3. So as already discussed, so under category 1, the scheme has to be close-ended. That means that the investor will not be able to withdraw the amount before the maturity, or it gets difficult for him to withdraw his amount. So there is a lot of restriction with respect to the withdrawing of amount before the maturity of the scheme. Same is the case with the category 2. However, in case of category 3, the discretion has been given to the fund to create either the open-ended fund or a close-ended fund. Then comes the sponsor commitment. So as per AIF regulations 2012, under category 1, 2.5% of asset under management or 5 crore, whichever is lower, has to be committed by the sponsor. The same is the case with category 2. However, in case of category 3, this percentage has been increased from 2.5% of AIM to 5% of AIM or 10 crore rupees, whichever is lower. Then coming to the taxation perspective, under category 1 and category 2, there is a pass-through status, which in my opinion is the biggest benefit under these categories because there is no taxation applicable on the fund. So it will be taxable on the hands of the investor itself. But in case of category 3, the taxation has to be done at the fund level. Coming to the minimum tenure of the AIF. So under AIF regulations, the minimum tenure laid for category 1 is 3 years. For category 2 is also 3 years. In case of category 3, if the scheme has opted or fund has been created as a close-ended fund, then the minimum tenure is 3 years. And in case the fund is open-ended, then there is no limit that has been prescribed under law. Then coming to the concentration criteria. So herein, not more than 25% can be invested in a single company or an asset class. Under category 2, there is a restriction that you cannot invest more than 25% in a single company. This restriction has been enhanced, wherein under category 3, you are not allowed to invest more than 10% in a single company. If I talk about the registration fee with respect to setting up of the category 1, it is INR 5 lakhs. For category 2, it is 10 lakh rupees, and for category it is 15 lakh rupees. Now coming to the point of leverage. Under category 1, the leverage is not allowed. Under category 2, it is also not allowed. Under category 3, the fund can take up the position of leverage up to 2 times the total fund corpus. That means the fund has the capability to take loan for the purpose of investing. Now coming to the eligibility criteria. So I'll in brief try to cover what is the eligibility criteria for the setting up of the AIF. So first is the fit and proper criteria. So as per the SEBI Intermediary Regulation 2008, a fit and proper criteria has been laid down by the regulator, which includes that the person or the entity need not to be an economic offender. And the list is very long. I'm just quoting few of the examples. So we have to ensure that the entities involved in the setup process is not eliminated from the fit and proper criteria. Secondly, the minimum qualification and expertise. So as per regulation 4G, the SEBI has laid down the qualification with respect to the setup of the investment, who can be the investment manager and what is the qualification. So the qualification, a person in the investment team has to have a minimum experience of 5 years. Also, there is a certification that has been incorporated by the SEBI that we call as NISM Series 19C exam. And this has been further updated and divided into the Series 19D and E exam recently. So the one of the team of the investment manager has to clear this exam. The other investment manager needs to be the professional who has the professional qualification. Also, the applicant or the entity established by the sponsor or the manager should not have been refused the registration by the board earlier. So these are some of the eligibility criteria that I wanted to delve into. Now coming to the process for the setting up of the AIF. So we have to firstly understand what is the structure that we need to float before for the setting up of the AIF. So there are 3 ways you can float a AIF. One is the trust, the second is the limited liability partnership, or the third is the company. So a trust can be floated through the trust deed as per the Indian Trust Act 1882, or a LLP. Under the LLP Act, a LLP can be floated, or under the Companies Act 2013, a company can be floated. So in our opinion, a trust is always a better structure in compared to the limited liability partnership or the company, because it has certain advantages compared to the formation of LLP or the company with respect to floating of the AIF. So these includes that trust as a structure will give you more flexibility in the fund, firstly. Secondly, it has a simpler regulatory compliance, which means that in comparison with the LLP or the company, the compliances of the trust is very limited. And thirdly, I will say the privacy. If in case we talk about the LLP or the company, anybody can pay a requisite fees and can delve into the ownership structure and the partners of the AIF. But in case of trust, this privacy is at most maintained, and it gives the fund a better flexibility and regulatory compliances. Now coming to the next, once we decide what will be the structure of the of the fund through which it will be floated, then we have to draft and execute the legal framework documentation. So I'll take only the example of trust. So if we decide that we are going for the trust for the floating of the AIF, then in this situation, the trust deal will be formulated, wherein the terms and conditions pertaining to the roles and responsibilities of the trustee will be dealt into detail. Then what will be the framework and authority with respect to the investment manager? Then along with that, you have to take into account that what is the process that we need to be adopted with respect to the boilerplate clauses and how the trustee will be appointed, what are their roles and responsibilities and things like that. Once the drafting of trust deed is done, the trust deed is executed between the parties. Thereafter, the trust is formed. The next and most crucial step is to draft an investment management agreement. So, what is an investment management agreement? So, investment management agreement is an agreement between the investment manager and the trustee, wherein the trustee will lay down the roles and responsibilities of the investment manager, entity, or the person who is acting as an investment manager to the fund. So, firstly, you have to be well sure about what will be the roles and responsibilities of the investment manager. What are the powers that is available to the investment manager of the fund? What are their rights and obligations? What are the limitations that an investment manager has with respect to managing the fund? And things like that. So, what is the major points that you have to keep in mind while drafting the investment management agreement? So, firstly, you have to be very sure about the roles and responsibilities that an investment manager has to fulfill. Then, what will be the governing law and jurisdiction? And if in case there is a dispute that arises between the parties, what will be the mechanism through which this thing will be dealt? Also, there has to be clear define of the fee charges and expenses with respect to the investment manager. So these are some of the few points that is important for us while we are drafting the investment management agreement. Now coming to the most important and critical aspect, I would say the drafting of private placement memorandum. So private placement memorandum, as I already told you, is the document wherein all the details about the fund and the schemes has been laid down. So it includes what will be the investment objective of the fund, what is the strategy of the fund, what is the process and what is the area that this fund is going to invest its money and things like that. So I'll just quickly cover some of the important points wherein we have to delve into while drafting the PPM. So these include firstly the executive summary. So executive summary is the summary wherein you provide the summary of all the provisions that has been laid down in the fund. That includes the vision and mission of the fund and the strategies we are going to adopt. What is the drawdown period? What is the closing and subsequent closing of the fund. Then comes the investment objectives and strategy and process. So this is a complete different chapter that we draft in the PPM. So it includes the investment objective that the fund has with respect to the with respect to the target sectors and allocating their investments into various strategies. Then comes the governance structure. So governance structure is the structure through which the process of the fund operates. So it includes a lot of entities, that is sponsor, then comes the investment manager, then comes the custodian, then includes the registered transfer agents and many more. So these has to be laid into the structure and their roles and responsibilities has to be clearly laid down. Then comes the track record of the investment manager. The regulator is always interested to look into the track record of the investment manager because they wanted to understand if the investment manager is suitable enough or capable enough to take care of the interest of the investor, or he or she or the entity has the enough capability to invest the money of the investors into the places diligently or not. So that is the reason the track record of the investment manager is also shown into the PPM. Then comes the principal terms of the fund. This is the most important chapter of the PPM because it contains all the terms that needs to be there in each and every fund with respect to the conditions of what will be the tenure of the fund, what is the fee structure of the scheme, what is the types of units that this fund or this scheme is going to provide, what is the minimum capital commitment of each class of unit that is allocated to every class, what is the rate of interest, what is the management fee that is going to be charged in the fund. So every minute detail has to be laid down under the principal terms of the fund. Then comes the distribution waterfall. So distribution waterfall is nothing but the profit sharing structure and the distribution mechanism which through which the money of the investors and the profits will be shared to the investors. Then comes the legal, regulatory, and tax considerations. So this chapter provides what are the legal laws, what are the regulatory laws and the tax considerations that will be applicable once the AIF will be set up. These includes the SEBI regulations, SEBI insider regulations. Then comes the Companies Act, then comes the income tax laws, and many allied laws which are interconnected with the AIFs. Then comes the disciplinary history. Then there are certain few declarations that we need to file with the regulator. These includes that we have to be involved, we have to declare that the entities of sponsor investment manager are not involved in litigation connected with the securities market, or are at fit and proper person based on the earlier security SEBI intermediary regulations 2008 criteria that I explained earlier to you. Then we appoint a merchant banker. So under regulation 12, it is a mandate to appoint the merchant banker and obtain a due diligence certificate from him. Once you get a due diligence certificate, you can file the requisite documents with the SEBI as per the prescribed Form A. So before you file the documents, you have to take the access of SEBI SI portal. For that, you have to pay a fee of 1 lakh rupees. Thereafter, you have to upload all the documentations that we discussed earlier. And then thereafter, once you submit all the documentations in the soft form, we have to submit the same in the hard copies as well. In case SEBI has certain queries with respect to the documentation we have provided, then we have to resolve the queries of the regulator as well. And thereafter, we get the approval from the SEBI for the setting up of the AIF. So this is the broad way and the process that we need to adopt with respect to setting up of the AIF. So I think this is it from my side. I will.
Thank you. Thank you very much. Thank you, Vaibhav. Okay. Now, Sanchit and Shivanshu, anything is left out which you want to cover? Then I can just say some few questions.
I think everything was covered from the legal standpoint, the wealth creation as a tool, and but I think we can you can give your closing remarks and we can have the.
Okay, now I have few questions. Manoj, I have few questions. That is, one is future landscape and regulatory evolution. What you see, Manoj, in this?
Well, it will keep growing. I think SEBI has obviously been doing a lot of changes in the regulatory regime to create more and more investors' confidence and curtail the malpractices. So a lot of transparency is coming. Processes are getting streamlined, and it is also increasing the investors' confidence. So this asset class, this investment class would keep growing because there is a influx of investments coming from the new age people who are now becoming HNI and ultra HNI day by day. So they want to invest in various purposes, but it is difficult for them to find different right investment opportunity directly. So it is always better to go to the professionals like AIF managers who can put the money and.
Okay. Shivanshu, today is a 1 crore rupees. So do you think in future the democratization will also take place in AIF? Mean they will reduce 1 crore to 25 lakh, 10 lakh. Do you think it will take place?
Uh, so there could be two schools of thought. I think certain retail investors who eagerly would want to participate in the AIF ecosystem because of the kind of deals that it enables. But I think from a regulatory standpoint, it will be difficult to scale back on the kind of commitments that we have. And even we might be seeing, because of inflation and everything else, this number might be increasing in the future times, because SEBI as a regulator, and we have also seen in the IPO segment and even in other segments, the primary motive is to safeguard the retail investors, right? So I think AIF as a category would be available to select individual investors or HNIs who will be able to commit at least 1 crore.
Okay. Sanchit,
I
you?
agree, yes.
Yeah, Manoj. Yeah.
Yeah, I'm totally agreeing. SEBI may not be able to reduce the investment size because uh, it has a risk associated with it, and hence it cannot be open for the retail investors.
By the way, Pawan sir, I think just to mention one point, so there is a concept of accredited investors in
Yeah.
the ecosystem. So if you are a accredited investor, so your ticket size will actually reduce, and if even if your AIF has to be accredited by SEBI. If both of those are accredited, then the investor can participate at a ticket size of 25 lakhs as well.
Yeah.
Okay, Sanchit, can you tell the global position in the gift city? It is coming out very, very high. So, do you think that in future the global positioning of Indian AIF through gift city will emerge in new dimension?
Uh, so definitely global positioning of Indian AIFs through Gift City, it brings uh, a lot more changes within the domain. And I think with the kind of asset classes that AIFs gives or make it accessible for investor, um, uh, we are at a very great positioning from that standpoint.
Okay. Shivanshu, AI and quant in AI management, will it take place? Because
So
quant is
very
also
interesting concept again, because AI fund managers, in the end the goal is to generate alpha, right? And for quant AI that you mentioned and AI technologies, uh, so fund managers, what I have seen particularly is they have been using technologies at very faster pace. I think information is the new fuel, and if you have any advantage to get information, even maybe extract large set of data so that you can have your own conviction on certain stocks, companies, or industries. I think it has already been start to evaluate in from fund managers perspective.
okay. Sanchit,
Yeah.
next big theme of AIF. If you have to pick one sector or theme that will dominate AI flow in next 10 years, what would be and why?
Next big theme of AIF.
Uh,
Uh,
Next 10 years, and you have to choose. So, in which sector uh, you will put investment? 10 years horizon, I have given you wrong because today you're not aware what happened in 1 year. So, but even then,
So I think
whatever
as
visualize.
we progress through 2025, Indian AIF's landscape is undergoing a significant evolution driven by regulatory reforms, technological advancement, shifting investors' presence. I think the next big thing would be somewhere in sustainable and ESG focused investments, probably technological and digital innovation, definitely not losing out on the AI factor. So I think that would be the next big thing within the AIF.
Okay, yes, Shivanshu, your call.
I think two sectors particularly, if we talk about Indian perspective, one is definitely renewables, because there has been a shift. Currently I just read an article that now 10% of overall energy generated globally is coming from solar, right? So there will be a lot more alternatives that we can work upon, for example hydrogen for cars, etc. So that is one. And second is particularly for India, defense, because 10 to 12% of our annual budget goes to defense, and currently we have been importing most of the technologies, but with recent developments, government is focusing on self-reliance in the defense sector as well.
Manoj?
Yeah, sir. Yeah, sir, I think sustainable development is very, very important and very key. So yes, renewable energy is the sector. Defense, obviously, I hope that there will be a lot of investment in education sector also and fintech also. But yes, renewable energy is the topmost
Okay.
sector.
Okay. Okay. Shivanshu and Sanchit, if SEBI is giving you an opportunity, please tell us one reform
Hmm.
in the AIF sector, which you think will give a more boost. So give me one, so all three will give one suggestion quickly.
Sir, one of my complaints earlier was because co-investments used to be very terrible in a AIF structure. So, for example, if we have certain family offices who might be asking for a co-investment structure as well, so SEBI didn't allow it. Earlier, it was just through PMS route, but recently, 2 weeks ago,
They
SEBI
have
came
changed.
with a regulation wherein they have provided within a AIF ecosystem, you can also have a different class of units allocated for the co-investments part.
Okay.
So that was a major complaint that was addressed. So we'll be very happy about that.
So no other desire.
Yeah, so we can talk about it, but yeah, that was
Okay,
heavily.
Sanchit, yours.
I think if I would talk about, I'll talk about it from the very relaxation and standardization of investment norm for NRIs and FPIs. I think harmonizing the rules for NRIs and FPIs to invest in AI, especially category 2 and 3, would also make a lot more difference. Enabling NRI participation from GIFT City and elsewhere could also unlock significant offshore capital, especially HNIs.
Manoj.
Sir, I think if we want to boost the size of the investment pool in AIF, yes, we can reduce the ticket size. But practically that is not possible. If we let's say if simply it is reduced the minimum commitment size to 25 lakhs, there can be tremendous growth in the AIF sector. But that may not be the right decision on the part of regulator, because obviously it is a high risk investment. It will become, sometimes there may be certain gray people who would misuse that, and it will be very detrimental to the investor. So that may not come, but otherwise regulation is growing very very well, and it is incomparable to any world class investment opportunity.
Okay, Manoj, there's one question relating to technological. In the West, large PE funds shape board decision, ESG practices, even public policy. Do you see Indian AIF develop this kind of influence and is desirable?
Not right now. It will take time, because right now almost all the businesses are controlled by families, promoter groups. So that would take a lot of time when there will be multiple PE funds owning majority of the stakes in the company, and the control change happen or decision making happens. So that would take a lot of time. Yes, for newest companies like Zomato, or other similar companies, this is there. So, but it will take time, sir.
Okay. So let's it's a 5:58 and we always try to close at 6 o'clock. So quickly, 30 seconds to everyone about this particular concept to close. Shivanshu.
Sir, AIF, I think I've been working in the AIF ecosystem for past 5-6 years now, and I think the kind of developments, the kind of ecosystem that we have enabled, and especially the kind of impact that we have been trying to create through the AIF ecosystem, I think that is tremendous, and that is also visible in the kind of growth the AIF industry has seen. So lovely to be part of the ecosystem and enable such investment.
Sanchit.
So I think Indian AIF regulation provides a very robust, transparent framework that fosters innovation, protect investors, fuels economic growth. I think within this framework, it gives an access to a lot better investment asset classes for various HNIs. And I think it's a tremendous way to enhance capital, increase, manage their wealth, support entrepreneurship, and position India as a very competitive destination for global alternative investments, and it's a very great cornerstone
Okay, Vaibhav.
investigation.
Yes. So, in my opinion, the one area that AIF has worked upon is attracting a lot of investments from the high net worth individuals and deploying it into the areas where the not the listed companies or the areas where the unlisted companies can attract a lot of investments. So I think AIF as a structure has really helped the investments to be made in niche areas, which is ultimately helpful for the development of our startup ecosystem. So this is, in my opinion, a very thoughtful and very renowned product, which is going to help the Indian economy becoming developed and targeting the achievement of 2047.
Okay, Manoj, at last.
Yes, I think everyone is very much right. This ecosystem is a great boost to Indian invest in Indian businesses. They are channelizing the investment of many HNIs, many ultra HNI people to the right investment of opportunity, right businesses where they can grow. So it has fueled the growth to many startups, great ideas, which can, and this legacy will continue, I think. Earlier we were depending upon the international funds only, but now India has its own big
Okay.
pool of funds.
Thank you very much. Thank you, Sanchit. Thank you, Shivanshu, Vaibhav, Manoj. And this was a very lively discussion and a very thorough interpretation of various aspects of AIF. And the way I have suggested and told you that 10 lakh crore rupees has already committed. In the future, the amount will go multiple times. India is touching 5 trillion economy, and the way things are moving, it means that same way it will also grow. Investors are always searching alternative things, and there are so many people, they want to invest money in mutual fund, in stock, in rate, in they want to give in PMS and various other way out. But even then, if you bring out something new, they will try to see this, and this sector is giving lots of revenue and the avenues also. SEBI has come out very thoroughly, and they are working out every time new reforms, new things, so this sector can grow up. And I hope that this sector will definitely see the new changes. We will see the thematic AIF, we will see the innovative AIF, we will see new ideas, we will see the various people will make customized thing, and various other new things in this area will come. And this investment vehicle, which is because no doubt one CR is one amount, but today, if you see the Indian millionaires or billionaires, they are surpassing any country in the way things are moving. So people have a surplus fund, people have amount, they understand things, they want to do it. And simultaneously, so many opportunity for AIF also. And this will help to grow country, and they will help for nation building also. With this, we have a bright future for AIF, and all should work together, make it more stronger. But the important thing is the communication and the transparency with the investor will make this sector very viable and very effective. With this, thank you very much to all. Thank you. And friends, as I told you, our knowledge journey is continue, and our next webinar of 221st, that is on 30th May, on ESOPs under the spot. Regulatory changes in ESOP disclosure for listed entities. This is the new things, because so many regulatory cases, regulatory issues has taken place. We will discuss this issue. Till